and welcome to FidelityConnects. I'm Pamela Ritchie. November set a record for ETF inflows in Canada. The real story kind of sits with what investors are buying and what they're avoiding. High-quality U.S. stocks are having their biggest underperformance, while value actually is gaining traction. And our next guest says the market is working in surprising ways. Joining us here today to unpack what this tells us about positioning from here is Fidelity Director of ETFs and Alternative Strategy, Étienne Joncas-Bouchard. Hello, Étienne. How are you?
Doing very well, Pamela. Thanks again for having me.
Delighted to have you here with us. You've just wrapped up en français, so you're speaking to the country today, which is awesome. Glad to have you with us. We'll invite everyone to send questions in. So record-setting month November was for ETF inflows, lots of stories within that. One of the big ones, though, is it kind of fits with the interest rate differential story around the world. Like, there is interest in countries and regions that are not the U.S. right now. It's an interesting story told through the flows. Bring us up to date.
Sure, absolutely. I think that it's a great point, and you know, we always try to look at it from where we are from a market cycle perspective, economic environment cycle, and what we've seen obviously is very responsive to. We're seeing in Canada, international markets, things that are working that are very typical of those periods, and hence, you know, the performance of a lot of those indices or products or funds. ETFs have done very well this year, and if we could pull up slide one to your point with regards to where flows are going, I think one of the truly interesting things this year, which we've mentioned a bunch of times, is international equity ETFs have represented half of the inflows into all of equity ETFs. But the story this month in November was Canada making a real comeback, being responsible for about half of that. Yeah, it's good to see. And, you know, actually, interestingly, it was the U.S. equity component that's lagged over the past month. And that was really the theme of the last couple years, kind of leading the way. And this year being very different in response, obviously, one, to performance, but I think, two, to your point, where it seems like there's a bit more of positivity around, you know, stuff outside the U.S., albeit U.S. markets are doing, you know, just fine. There's nothing quite wrong there yet, obviously, or might not happen. But we have seen this kind of heightened demand for Canadian equities definitely in the last month. And really the story of the year altogether is that we've brought in, you know, $109 billion in net new assets in the Canadian ETF industry, which is definitely a record year. And this was a record month, obviously, like you mentioned in your introduction there. So all in all, very kind of risk-on sentiment, generally speaking, much more equity demand than fixed income. We're also seeing that, you know, a lot of demand for gold ETFs, which actually slowed a little bit in November, but all in all in the year, north of $1 billion going into gold bullion ETFs in Canada. A couple other points to make there. The rise of inverse and levered products. That's a category that's doubled this year in size. And there's been a lot of net new issuances, so a lot of other asset managers out there, not including Fidelity for the most part, you know, looking to gain traction in that space that's been heavily dominated, I say, by the retail investor and direct retail investor on those kind of discount brokerage platforms looking for either a higher risk profile or a higher income profile, because a lot of those levered products kind of fall in that bucket, but are really kind of operating these covered call type strategies to enhance the income on either a sector, a broad market index, or even, I would say, more recently on a specific stock. So that's a growing category to keep an eye on. And crypto's been positive for the year, but definitely muted a little bit over the last month as, you know, Bitcoin has sold off close to, you know, 30% from peak to trough. Recovered a little bit, but still some vol in that space.
Okay, fascinating. And we want to dig into that a little bit as it relates to how you invest and the all-in-ones particularly. But I just want to pick up on what you were talking about with Canada, some of the changing dynamics there of interest and the equity appetite, really, that's continued for the last little while. It's always been fascinating to me that the way that you invest, and we'll go to the all-in-ones a little bit here, and then we'll probably come back to them as well. Your exposure to the so-called Mag 7, which sometimes is a bigger number or a smaller number depending, is not huge. You have it in the U.S. Funds themselves, but you've done well. It's been an interesting place. But just sort of talk about that dynamic. You've done well without having overexposure to some of the hugest valued names in the index. It's you stay away from that, manage to do well, but just talk about the decision making behind that.
Yeah, so obviously the core structure of, whether it's the all-in-ones or say our all-American equity ETF, which is the U.S. equity allocation of the all-in-ones, has an underweight to a lot of those names, and it's not necessarily a conscious decision that we're saying we want to underweight these names for X, Y, and Z reason, and I could name a bunch why you could either want to overweight or underweight them. The reality is the way that we screen for stocks, whether it's using factors like value, quality, momentum, low volatility. Those are the four main ones, obviously, that we incorporate. Some of them score very well in certain categories. Some of them don't score well in other categories. But when you take the sum of parts, they have been fairly volatile, albeit that volatility has generally been to the upside. It's still vol. For the most part, they do score quite well on quality, with the exception of a few in there. They're fairly expensive, though. The bucket of Mag 7 right now trade about a 10 forward PE premium, so 35 versus about 25. And then, so not particularly scoring well on the value side. And then from a momentum perspective, some have had strong momentum, some have had kind of a weaker momentum by the fact that we look at vol-adjusted momentum as well when we're doing our rebalancings. So, areas like gold, for example, had been, they haven't necessarily risen as much, albeit some names have. Names that we have in our portfolio, like a Newmont, for example, that's in our U.S. value ETF or in a momentum ETF. Like those names have done really well, but they've also appreciated in a more stable way, and that's kind of one of the reasons why they've outshined in momentum. But to your point with regards to performance and kind of in a challenging environment for this type of approach, where we are selecting stocks based on fundamentals, not necessarily just sentiment and or technicals, and even momentum is just one part of the whole, I guess, recipe. There's a lot of other things that have worked, and there's a lot of things that have worked as a bifurcation off of the AI trade. So for example, Caterpillar's been one of the it's overweight in many of our different ETFs that we have in that portfolio. That's a company that's obviously benefited from the fact that there's an understanding there's going to be more demand for machinery as we have more needs for power, for infrastructure. That's in Europe, obviously a very big infrastructure kind of theme, if you will, going on. Those are names that help us in a time when it seems like everybody's talking about AI and tech. There's a lot of other things that work. Now, utilities also being one that's a net kind of beneficiary from this AI trade, but it's not really in the infotech category or sector. So all in all, a pretty good year. We've slightly lagged in our U.S. equity allocation, but we're very comfortable with where we're positioned, where we have about 18% to the Mag 7 relative to slightly north of 30% in our benchmark. So yeah, we like that position going forward, and I can maybe expand on that after.
Well, I was going to say it's sort of the going forward piece that is probably of interest right now, because whether there is or isn't an AI bubble, that almost feels like old news, actually. I feel like we were talking about that at least a week ago. That almost feels like. But it is a concern going forward for some, and therefore probably the allocation you have to those going forward might be of real interest.
And it's a going concern for some, for sure, because we hear it from our clients all the time. Some obviously would say, I want more. But I'd say for the most part, people are saying, I think this is starting to get fairly heavy. And we've been talking about this for 3 years, it feels like. But the reality is, and I did some digging yesterday, and unfortunately, I wasn't able to get it in time to put it in a slide to share with everyone. But I'll share with you the numbers and the findings. And, we've seen outsized and magnificent, if you will, or exceptional performance from these names, but it was very well deserved by the fact that they consistently delivered stronger earnings growth than the index, right? So above average, to a point where at the end of 2023, we were talking the average growth rate of the Mag 7 was 80% higher. Not like it was 10% and then it was 18% or whatever. It was a total absolute spread of 80% more earnings growth, which has then gone to 30% last year. Right as of the end of October, if we look at the trailing 12-month earnings growth, it's about 17% more, and it's expected for next year, using consensus estimates, to be 10% more. So now you're in a kind of crossroads where you're paying a PE premium of 10 for 10% more earnings growth than the broad market. And the reality is the broad market's expected to be basically flat for next year. So, it's a situation where you look at, it's not to say like they won't necessarily do well, but how much more exceptional can they be? How much size should they be in a portfolio? And that's kind of like, I think we really truly are at a crossroads for that, like I said, excess performance that has been, once again, deserved.
Yes.
Will it manifest itself again going forward? It's just getting harder and harder, one, to beat the estimates because the market's gotten so positive on them, and then also to continue to deliver in that environment. So it's going to be very fascinating to see next year how that dynamic changes. But like I mentioned, I think we're really well positioned with regards to those names. We have allocations to some of them that are heavier than others, but there's a lot of other stuff that's looking pretty good as well.
That can catch if leadership starts to shift or is more interesting in other areas as well.
Hello investors, we'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
I wonder if we can bring up, it's your slide too. This takes a look at sort of the regional story, the business cycle, some of which you've mentioned. But it's such a great visual to look at how, I was tying it to interest rates. You can tie it to lots of different stories of it looks like Canada perhaps missed the recession. We heard Tiff Macklin speaking this morning, and he was addressing some of these things that are often put to him. But one of them was, did Canada kind of escape a recession, and therefore are we in early cycle? I put some of that to you and how you look at it through an investment lens.
Yeah, and I won't go too much into details into did we go through a recession that just never showed up on the actual GDP numbers? Are we do we have a stronger labor market because the public sector has been so good? All these things. It's really, I'm maybe not the best positioned person to discuss all those. But one thing that I will say though is that what is working in Canada and what is working in international markets is very much more indicative of an early cycle and a mid-cycle. When I say the stuff that's working, I mean the equity sectors, the underlying stocks that are generating excess returns relative to the benchmark is more indicative of an early and mid-cycle environment than it is of a late cycle. Okay. Whereas quality usually does really well in late cycle, it hasn't really done well in both those regions. Very kind of different than what we've seen in the U.S. where it's heavily dominated by momentum. But a lot of the quality names, albeit they've underperformed, they've delivered on performance. They've just kind of been left aside. So we actually really like that positioning for next year. So looking at U.S. quality names seems like they're well positioned from a valuation perspective, and their profitability hasn't really been eroded in the past year. But what's interesting about this chart once again is looking at IFI, looking at Canada, its sectors. Obviously, that Canada's a little bit different by the simple fact that if you remove precious metals, you're taking away about 30% of the return of the TSX this year. So there is a bit of a story there, which is kind of like not a unicorn, but it's very idiosyncratic related to the price of one commodity. So a little bit unfair. But if you do have a stronger commodity cycle where copper's been doing better, silver appreciated, gold's appreciated, well, generally speaking, energy should follow, which would be a net beneficiary for Canada in the coming year, or even in the short to medium term. Once again, no opinion on where oil prices are going, but that could be a logical kind of development. For international, it's really been this theme that arose at the beginning of the year when there was change in policy from the U.S. with regards to the EU, basically saying you guys need to take care of yourselves now, and many different governments as part of the EU bloc, if you will, changing their tone with regards to defense spending, changing their tone with regards to running deficits. Germany has been very, very precarious in the way that they've managed their finances, in the sense that they've run surpluses or been even par on their budget, something I think have forgotten if that is even possible in Canada these days. They had been doing that for a while, and now you have better monetary policy. You've got governments willing to spend, and you've seen that kind of manifest through sectors like industrials, Through financials, obviously, we're going to be financing a lot of this. And utilities is another one as well that's done really, really well in international markets.
It's fascinating. Should we take a look at the the all-in-ones, and just go through sort of the discussion while we look at them themselves? It's so interesting to take a look at the factors, which are, as you've mentioned earlier, are all there in each of them, sometimes with different allocations. I think this is slide 3.
Yeah.
And just kind of go through what's been of interest mostly to investors. I mean, when you take, I'll ask you now about the factors and including them all. You've sort of spoken around it, but come back to why you do include them all, because you would think you would kind of shift them around depending on what appears to be coming, whether it's momentum, low vol, whatever it is.
Yeah, no, it's. I mean, there's a lot to unpack there for sure, and even and sometimes I get stuck in the fact that I'm talking about these things every day, all day. But for
Some
those
are seeing it for the first time. Yeah.
Yeah, exactly. So I need to take a step back a little bit, and even like what a factor is. Like really, I kind of mentioned earlier where it's like a quantitative approach where we select stocks based off of defined characteristics. Like a value factor is simply us building a basket of stocks that display strong valuation, metrics, if you will. So whether that's like a price to earnings, a price to book, free cash flow yield, et cetera. Same thing for low volatility. It's pretty self-explanatory. Like we build a basket of stocks that display lower volatility profile than the average company in an index, and so on and so forth for the other factors. And really, a lot of this stems from, it's called risk premia, but it comes from academia. We've seen that if we pick stocks, using these metrics over time, over long periods of time, we've seen excess returns, right? And we want to capture those excess returns with these types of ETFs. But they are strategic in nature in the sense that, over the longer the time period you look at, the higher probability you are of generating that excess return. But in a given year, in a given 3-year kind of cycle or 5-year cycle, there's some factors that do really well and some factors that don't do really well. And hence why, to answer your question, why we include all 4 of them is that if we combine them together, not only do you get a great diversification effect, but then you're giving yourself an opportunity to not miss out on the period where each factor is adding value. And I think that's really kind of the basis of the construction of the all-in-one ETFs, especially if you go further down the kind of equity component where it's basically only factor ETFs in there. But obviously, as we go down the risk profiles, we add fixed income, we add some active management. But that's really kind of the core principle of these portfolios is these factors give us a style diversification that helps manage risk, but also gives us a chance to capture that excess returns over time. And then obviously then we try to find ways to complement that. We add active small caps, we add a little bit of cryptocurrency as a third asset class in the portfolios. There's a bunch of different things that we do around the edges to enhance the portfolios, but it really does come down to kind of the factor core, if you will, for most of them.
The active small cap component, that is the fund that is run by Connor. And yeah, this is a sort of a slice of that. Okay, so we'll ask you about, and Chris Maladinsky, I'll ask you about Bitcoin because you can go through initially why it's in there, but also we need to ask you about some of the massive changes that we've seen in the price of it itself and perhaps beyond that, and sort of why you put it in there, because let's start there.
No, it's a great question, and I love answering this question. Well, it's one we get all the time, right? So we get it all the time because it's unique. We are the only asset manager in Canada to include it as a base allocation in our multi-asset solutions or ETF portfolios. So by the simple definition of being different, you get questioned about it. Now, obviously, on top of that, it's a very volatile asset class, right? We're talking about something that displays volatility characteristics that's a multiplier on equities, which is traditionally kind of the risk on part of the portfolio, right? So because of that nature and because of the boom and bust cycles that we see for Bitcoin and other cryptocurrencies, we naturally get a lot of questions. So I'm happy to answer it. And the way that we've looked at it to incorporate it in the portfolios is obviously not looking at, we want to add this because it's done well over the past 5-7 years. No, we're adding it for a few reasons. We're adding it for one reason, diversification effect. Other than a year where like 2022 when correlations get very close to 1 for pretty much everything except cash, it tends to be a good diversifier to equities and fixed income. That being said, it is also like a levered equity play or levered like NASDAQ to a certain extent. That's kind of the characteristics that it's shown over time. And that's particularly why we need it in the portfolio. And I'll explain a bit further is if I take all of our equity factor allocations, whether it's Canada, US, international, all three of those, if you look at them as like in silos, they are less volatile than their benchmark index. So for example, like our All-American Equity ETF, which we talked about a bit earlier, it is less volatile than the S&P 500 because we have a low vol ETF in there, because we have a value ETF that has protected in kind of these corrections over the past 5 years. So when we include Bitcoin, it's not to say we want to increase the risk profile of the portfolio or it is actually that's not true, to increase the return profile of the portfolio. It is to increase the risk profile of the portfolio to get closer to our competitors so that we don't miss out when we have very strong upswings, right? Yeah. So actually, if we look at the performance of the all-in-one ETFs, our best performance periods are when Bitcoin is down. Okay. And that is super counterintuitive.
That's super fascinating.
And that was especially true in 2022. And it was true especially since it dropped from October 6th until the end of November, where it was actually our kind of strongest period other than March this year, which was, once again, a volatility period. So it's inherently, like I'm almost, it's once again, I got to be careful with what I say, but it's almost a good thing when Bitcoin's down because it means the rest of the portfolio is going to likely outperform quite substantially relative to the broad benchmark indices.
It's so interesting, the offsetting nature of it, and as you say, it's diversification, but it's got that that counterintuitive. When it's down, it provides some very interesting places for the rest of the portfolio to balance things out. This is a great question coming in. So for Fidelity factor-based ETFs, how often does the quant team review and update the models for each strategy? You've gone through this many times before, but I mean, you're not in there tinkering all the time, reacting to every single market change at all. Just take us through your strategy.
No, absolutely. Happy to answer that. And I think we have an even better guest on Friday on FidelityConnects to ask this. Bobby Barnes, our head of quant index solutions. But Bobby's team, they're constantly reviewing the way that we structure these models. It doesn't mean that we're looking to change them. I mean, this is years and years and years of research showing what we think is the best definition of value, what we think is the best definition of quality. So that doesn't necessarily materially change over time. I will point to an example though where once again like that kind of review process or constant review is the right word. Back in 2020, when we had, obviously the COVID-19 pandemic was coming, a lot of businesses were forced to shut down. We had kind of this global phenomenon that was fairly unique and we'd never experienced before. So, for companies to protect themselves from eroding, their balance sheets, a lot of them were forced to cut their dividends, halt their dividends. And what we did is change the review process of removing stocks from our dividend ETFs, where in our methodology it said that at the end of every quarter, if there's a stock that either cut or halted their dividend, we're booting them from the portfolio. And then at the next set rebalancing period, we were going to backfill it. We weren't necessarily going to add a name if we removed one. But what we ended up doing is saying, okay, maybe that's not right because we're going to have to remove like 15, 20 names out of a 60 stock portfolio. That now we're creating another risk, which is stock risk, but also sector risk. If we remove 2 stocks from say, the utility sector in Canada, you're left with nothing really. So what ended up happening is now we moved the process from being purely quantitative to also relaying the information to our active managers and our active analysts to say, this company cut its dividend. How do you feel about the stock? And also, do you think this dividend is coming back in the next 6, 12, 18 months? And obviously nobody really had a clue if it was coming back or not, but just having that active lens of saying, I think this company's gonna be fine, albeit it's cutting its dividend. Whereas this other one is cutting it out of necessity because they're about 6 months away from, potentially having some real financial issues. So that's maybe an example that I could give to the audience, but once again, we're not changing them up very often. It's not the principle.
Occasionally, you also will, I remember there was a point, I think it was last year, maybe the year before, you'll tell us, changing your bond allocation because there was an opportunity actually to increase some exposure for some of the all-in-ones, and it was a good moment. And in fact, you sort of walked in it as an opportunity to add.
Yes.
Just take us through that, because that's a slightly different kettle of fish.
Yes, no, so exactly. So that's not really like impacting, say, the underlying models on the factor ETFs. But when we look at, the bigger picture, the all-in-one ETFs that kind of, and capture all of these different strategies, that is being reviewed also on a constant basis by myself and obviously a few others on our team here at Fidelity Canada who've constructed the portfolios. And the idea is to say, how can we continue to enhance these? Can we improve diversification? Can we what are things that we can do around the edges without playing with the core, because we like the core and we want that to be consistent over time, but how can we continually update this and keep this relevant? And what we've done is, for example, this year we added the 2 new US fixed income focused products, which was something that was, when we're looking at our fixed income lineup, it seemed like we were a little bit underweight relative to, obviously, to the size of the US bond market, but that's not really kind of the benchmark that we looked at. It was more kind of the mix of regular ETF portfolios and saying, yeah, okay, maybe this is something where we can improve on. So we added 2 new strategies. One that's a very core kind of index-like, but trying to, so that's our core US bond, trying to make it a bit more efficient allocations with regards to different maturities, but also different, mix between credit and treasuries. And then a fully active solution, absolute income, which is more of like a high yield type product with a little bit less vol, so using some derivatives in there to remove some of the credit risk, but ultimately generate more income for the portfolio. And obviously those 2 allocations have actually been beneficial this year as US bond markets have slightly outperformed global.
If we go back to equities, what's your favorite factor? Are you allowed to have one?
It's kind of a tough one. You got to love them all. But if we, there's a few different things that you've got to consider. I think one thing that's hard to see is momentum really changing in the short term. I think momentum's worked really well in the past 2, maybe almost 3 years, but definitely the last 2 years. And there seems like there's a lot of the positionings that we have right now is not even really kind of the noteworthy headline stuff. We just did our rebalancing in November, and I look at the portfolio in the US, it turned over 44% of the portfolio, and it's now positioned in other areas that, they're not overweight the Mag 7, they're not overweight a lot of the AI names. There's some in there, obviously, that have done very well, but there's other areas that seem to make sense, and it is tilting a little bit more back to value and some quality names that may be left aside a little bit. And I'd say the second one would be quality, so I'd kind of rank them in that way, momentum 1 and quality 2. That being said, once again, value in kind of the outside of US, I think has legs, especially in the international side, for the simple fact that there seems like the themes that we've been hearing about are going to start to play out. And so now the catalyst will be, are these companies delivering on the higher expectations that we've put on them by rewarding, obviously, their share price and earnings revisions being moved higher. Is that going to play out? If it does, I think value likely still does well there, but momentum is going to be hard to beat until something materially changes. So it's kind of a boring thing to say in a sense. It's like it's going to continue working. It doesn't until it doesn't, but that's the way momentum works. And I don't see a major shift in the way either central banks are going, which would actually probably be, if there's anything, they're likely to move more dovish, notably the Fed. So I think the show goes on to a certain extent.
It's an interesting strategy to help people stay in and not worry when moments of market volatility strike, basically.
Yeah, and I could say this, and maybe in 2 months' time things have changed and we look for something else. But it's the way that we construct our portfolios, the way we construct the regional equity ETFs, the all American, all Canadian, all international. Like, we are getting a base allocation to all 4 of those factors because we precisely know that it's very hard to pick a specific factor at any given point in time, and those rotations can happen fairly swiftly. But owning all of them ensures that we're capturing, the strategic alpha over time. And so, my favorite solutions are definitely those because it removes a lot of the kind of decision making and timing out of, we always, the old, saying of, time in the market is more important than timing the market. Like, that's really what we're doing with a factor combination instead of just picking one factor. So can't really fight that.
No, you can't really fight that. Absolutely. Étienne Joncas-Bouchard, thank you. We wish you the very best for the holidays. Thanks for joining us here today.
Absolutely. Happy holidays, everyone.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.